The value of positions can go down as well as up. Past performance does not guarantee, nor does it predict future results. So with that out of the way, the first part of the presentation, I'm going to talk a little bit about the economics situation and monetary policy. And that really is a good primer for what we're going to look at as we get into the rest of the presentation and the markets component as well. We all know that the Federal Reserve recently decided that it was going to cut interest rates, and not just by a little bit, but by quite a lot. They did a 50 bips cut in September, and this was while financial conditions were actually very loose. You can see where the hiking cycle took place, and we sort of peaked out just around the point where we saw the government engaging in rather aggressive fiscal stimulus. The CHIPS and Science Act, the Inflation Reduction Act actually helped to significantly loosen financial conditions into the present. You could say the government fought the Fed and the government won handily. And it actually was a bit of a game of 4D chess, and we'll get into why I believe that to be the case in just a moment. But the Fed's not alone. September of 2024 has been the biggest month of monetary easing since April of 2020. So it's pretty incredible to see just how much easing is happening right now around the world. We've had 21 cuts in September of 2024 versus March of 2020, where there were 49 cuts. So again, we're seeing that sort of liquidity cannon pointed at the broader markets, and it is having an impact. And certainly we can see that impact in places like gold, which has been a beneficiary of that abundance of liquidity and that drop of rates. But why did the Fed really cut? They cited the labor market. When we look at the number of unemployed persons per job opening, it's actually just normalizing. We can see we're just going back to pre-COVID levels of labor market normalization. So there's nothing that suggests imminent weakness or a reason for the amount of cuts that were released on the dot plot. That's 300 bips of cutting to include the September 50 bips cut by the end of 2026. If anything, it suggests there had to be an ulterior motive here. When we look at yesterday's ADP data, it showed job creation was widespread and actually rebounded after a 5-month slowdown. So again, really only one sector, technology, of course, because there was so much overhiring there, there's still slack, lost jobs. The rest of the sectors gained. Even manufacturing added jobs for the first time since April. And it was a continuation of the K-shaped recovery theme as well. Small businesses were the only ones with net layoffs. Establishments with 1 to 19 employees laying off 13,000 by the count of ADP. And large companies, the biggest hiring component of the survey, companies with 500 and up employees, were hiring in excess of 80,000 people. So again, you can see that there is this sort of K-shaped economic distribution of outcomes, with smaller establishments struggling and larger companies seeming to do just fine. But let's also zoom out, because we always talk about the rate of change with inflation. But this chart isn't about the rate of change. It's about the cumulative change that has happened over the last quarter century. And we can see with little interruption, it's been up, and away with the prices that we all have to pay, whether we're at the grocery store, buying a house, filling up our car with energy. It is all about higher and higher prices. In fact, monetary and fiscal policy do everything they can to deflect against deflation. And while we can understand that deflation tends to lead to poor economic outcomes, it's actually, for the longer part of our economic history, been healthy. It's been part of the equilibrium that helped keep prices stable over long periods of time. You'd have these flushes and you'd have periods of inflation, but overall you'd reach some sort of equilibrium. That is not the case anymore, and it hasn't really been the case since the 1970s, where it's been much more up, and away. So when folks are sitting around the dining room table and talking about bills and talking about what all is going on in the world, they're not sitting there wondering about the rate of change. They're sitting there talking about the cumulative impacts of inflation. So let's get to why the Fed probably really cut. The fiscal impulse is wearing down. So for one, the Fed is actually the recipient of the baton from the Treasury, basically saying, okay, we've done everything we can at the Treasury side to stimulate, or the government side to stimulate. And now we're starting to see that fiscal impulse wear down. It's down about 6% year over year as of June, and falling even more into the present. Yet on the other side of it, with all that spending behind, the Treasury interest payments are surging. And in fact, this year, looking at about 1.1 trillion of interest paid, and assuming similar rates going into next year would be about 1.4 trillion. Or if we get about 200 bips of Fed cuts, hey, look at that. We save about 200 billion on interest. The real reason the Fed probably cut is because the U.S. is well outpacing its peers in terms of the debt interest payments as a percentage of revenue. The government has done a lot to fight the Fed to ensure the economy doesn't slow down. And you could say Janet Yellen won her four-dimensional game of chess against the Federal Reserve by having this much money spent and interest payments surging this much as well. And then that fiscal impulse running out. The Fed almost had no choice but to step in and do something. The question on all of our minds is, was that the right thing? And I think we're going to have to look at some more data before we draw that conclusion. On the one side of the K-shaped recovery, that lower part of the recovery is manufacturing. It has been in a contracting environment for 6 months in a row, and really for the better part of over 2 years. And we can see the data that came out earlier this week is continuing that trend. The one area of relief maybe is prices, which are finally showing some signs of decreasing after months of increases. Services PMI on the other side of that couldn't look better. In fact, one of the best readings we've had in years, and services have been growing. And really, it's kind of interesting to see this, but it's a completely different picture than what we're seeing in manufacturing. Much more demand, much more robust. While services are about 70% of business contribution to GDP and manufacturing is a much smaller component, about a quarter. Nevertheless, that manufacturing recession is probably something else that maybe has the Fed's attention to some degree. But let's shift our attention over to China. China's done some eye-catching, headline-making stimulus, and the question is whether it's going to be enough. They threw about $120 billion of stimulus into their market, and it's really an effort to try to stabilize their real estate market, and particularly their residential property market, which unbelievably is the largest asset class on Earth, with a notional value of about $62 trillion, with $11 trillion worth of inventory overhang. This is the real reason that China is doing what they can over the last 2 years and several months to try to stimulate their economy just enough to ensure that this key asset class doesn't collapse. But it has been losing value for years. In fact, the Chinese property market has been in decline. And this is a problem because most Chinese savers have their money in real estate. They don't necessarily buy stocks. They tend to buy real estate and to a lesser extent gold. So we can see that there is this motive of the government to say, okay, well, how can we boost domestic consumption again? Well, we better do something to try to address some of these problems in the languishing housing market. And it seems, with all the noise that the Communist Party of China is making, that they're taking it more seriously. But I still hold ultimate judgment for now, because I think they have a lot more work to do to stimulate in size commensurate with what their real estate market would need to start to recover. And on the other side of it, we've had so many head fakes and so many empty promises over the years that this could end up being another similar situation. When we zoom out and look at the heat maps of manufacturing and services, or non-manufacturing PMI in China, we can see they've been in contraction for quite a long time. The better part of the last year at the very least, which is another reason with their economy, that sort of two-pronged economy of exports and domestic consumption, that we could see why there would be this impetus to try to stimulate into an economy, the second largest economy in the world, the largest consumer of raw resources, why there might be an attempt to try to stimulate, particularly given that we're not likely to meet their growth goal this year, which was 5%, and right now it's starting to look much more like it's going to be maybe 4.5%. So again, this led us to China's $114 billion stimulus package. It boosted the stock market, but is $114 billion enough to stimulate a $62 trillion market? The math doesn't quite add up there. It still feels like there's a lot more to do. Another area of interest is the port strike. It's underway. It started at the beginning of this week, and it is set to cause some disruptions in the East Coast and Gulf, but I don't think it's anything to panic about. And I've heard a lot of folks kind of freaking out, like, oh, I better stock up on X, Y, and Z. I don't know when the next time is I'm going to be able to buy things like frozen foods or produce, or in some cases, and this makes no sense to me whatsoever, but toilet paper. Toilet paper is on the list of things that people are hoarding. Toilet paper doesn't tend to come in by the ports, by the way. A lot of it is domestically produced. Some of it's produced in Canada. The majority of it doesn't need to go by sea to get here, but nevertheless, anytime there's a shortage of anything, or even a perceived shortage of anything, it seems like the first thing to get cleared off all the shelves is toilet paper for whatever reason. And these are things that I have trouble comprehending, because if you're going to buy things that might be impacted by a shortage of imports and port availability, I would think the things that are actually coming from overseas would be the things you'd want to stock up on if you need to stock up on anything at all. Personally, I'm not stocking up on anything. I'm confident we'll get through this with some inconvenience, maybe some delays, maybe some products that are out of stock, maybe some price hikes. That's about it. But I do think there's opportunity here. If this strike lasts long enough, and to me that's over 2, maybe 3 weeks, then we could see beneficiaries in rails, in air freight, in freight by sea, and in trucking companies that are used to help reroute all of this cargo from the West Coast ports into these areas in the East Coast and in the south of the United States that would need them. This could also benefit oil, and we can see that oil positioning is really low. So even though we've had this bump off the bottom in oil, you can see the positioning measure, that red line of large traders, large speculators, is still pretty low versus long-term trends. In fact, the overall open interest in oil is also very low. Liquidity is quite low in the order book as well, which means it doesn't take a lot to move price, as we've noticed, going both ways. And we're seeing also something that might be giving Powell pause. Outside of what's happening in China, commodity prices have staged a pretty powerful rally off their lows, almost as if the risk of inflation reigniting isn't so far in the rearview mirror as we've been led to believe. And in fact, home prices never retreated, which is interesting because in August of 2022, we got that fire and brimstone speech from Powell talking about this big reset. Earlier that year, he also directly called out a housing bubble and told us to expect a reset. But during the most recent Fed press conference, he said that's now the government's problem, which is interesting because that's telling me two things. One, it's telling me the Fed doesn't really care about housing structural contribution to the shelter component of inflation as much as it probably should, given how unaffordable housing has become in this country for so many. But two, it's also a bit of a tacit admission of the Fed saying we're not really part of the government. Many people sort of seem to believe they are, but the reality is the Fed is more of a private entity with some public-facing presence, largely the Board of Governors and the members of it that are selected by the Senate. And so Powell signals a much more gradual pace of further cuts, a big departure from that hyper dovish jumbo cut and dot plot signifying 300 bips of cuts by the end of 2026. Powell recently coming out after the Chinese stimulus, as this port strike is starting to take place, as we're seeing tensions boil over in the Middle East and commodity prices coming off their lows, saying, you know what? Maybe we're not going to go quite as hot and heavy. And that did bring down Fed funds futures expectations of just how fast and deep this cutting cycle could go. So let's segue over to my favorite part of the presentation, named after myself, markets and mayhem. We are right ahead of this very consequential and probably tumultuous election season. And often is the case with data going back almost 100 years from Goldman Sachs that we have some volatility during the month of October during that same election season. So it wouldn't be too unusual to consider that from here, the path of least resistance for now could be sideways to lower until we get through the election, in which case seasonality tends to bring us back up to that structural bullish price discovery in the S&P. Adding to that risk is that we're coming up on earnings season. The week of October 18th, 12% of S&P market cap reports. The week of October 25th is the big one, 37% of S&P market cap reports. And then finally, we cap it off on the week of November 1st with 24% of S&P market cap reporting. Why does that matter? Well, there's obviously the event volatility risk of earnings, which we saw during the last earnings reporting season that some of those tailwinds, that AI narrative, were beginning to give way. Investors were starting to show a lack of patience for all that aggressive ROI not happening. There's been enormous amounts of CapEx, but other than the pick and shovel sellers like the NVIDIAs of the world, a lot of the downstream companies that are buying the pick and shovels aren't necessarily able to discover gold. If that is a continuing theme, I think it could be a big headwind for the NASDAQ, and we'll be very interested to see how the Inglorious 493 go, because we've been told to expect better earnings growth from them and slowing earnings growth from the Mag 7. And that brings us to our next concern. As we approach earnings season, what happens? We go into corporate buyback blackouts. And those buyback blackouts are consequential because that's the largest source of liquidity coming into this market. So if buybacks are on pause, that does heighten the potential for volatility, particularly in a market where liquidity has been constrained for some time. I've talked about it repeatedly in the S&P 500 order book for futures. There's been about 35,000 order book depth. That's so much lower than what it needs to be for a stable, well-functioning market. And we can see it, how the market trades. It's been a bit erratic. But then there's also the talk of cash on the sidelines. Oh, there's always so much cash on the sidelines to buy stocks. But wait a minute. What if that's not necessarily true? When we look at U.S. equity mutual funds, there's only about 1.5% of their portfolio in cash. So if there is that dip, we don't necessarily have these folks prepared to buy. And then some would point over to the money markets and say, well, look over there. There's all that cash parked on the sidelines, just waiting for the Fed to cut, and it'll come pouring into the market. But curiously enough, after the Fed cut by 50 bips, more money went into the money market rather than coming out. Then we've got asset managers who are basically as max long as you can be in U.S. equity futures. So again, giving you that sense that everyone's kind of on one side of the boat here, and it's getting a little bit topsy-turvy. So as we get into election season, we see the potential for volatility to start to appreciate. When we look back at the last 20 years of data from equityclock.com, we see typically in the earlier part of October through mid-October, volatility gets a bit of a boost. So this is one reason I like at the money 3 to 6 month out VIX calls, at the money 3 to 6 month out S&P puts as hedges. These are not directional bets. These are hedges against a long equity portfolio. But after election season, assuming this election isn't a total disaster, volatility tends to drop pretty significantly, pretty quickly, which could give us an opportunity to fade this move on the other side. If we get that big spike in the VIX, maybe that's an opportunity to cash out of those hedges and take the other side of the trade. We'll see how that develops as we approach that time period, and certainly it'll be something we're tracking here at TraderAid. Now let's look at year-to-date performance. The S&P 500 been led by utilities, even beating technology, and then communication services, which is really just a friendly way of saying technology given the weightings of that sector. But over the last 3 months, something else has happened. Remember that great rotation we started to talk about in mid-July? Yes, that is exactly what's playing out. So you can see tech really not doing so well. Google down almost 11%, Microsoft almost 10%, NVIDIA down over 7%, Amazon down about 6.5%, all during that time period. But the rest of this chart looks pretty darn green. So what's happening? Well, the Inglorious 493 are finally getting their bid. If you look at RSP versus SPY, we can see that rotation happening right before our eyes. This is one of the pair trades that we put on in mid-July. It's still working. It's been consolidating the gains, but I think there's more upside from here. And I do believe that Q3 earnings season will be quite consequential for how that ultimately goes. But this is one of the pair trades. Long, low volatility, high dividend payers versus high beta is another. Long value versus growth is another. These are all trades that in this rotation, in this shifting cycle, I think could continue to work. Let's shift gears a little bit into the world of gold. Boy, have China funds been buying gold. In fact, record amounts of gold buying. Some of this is largely probably because of uncertainty of what's going to happen in the economy and otherwise. Some of it is also likely speculative flows. And then there's probably folks there saying, I'm going to diversify out of real estate because that really hasn't been working for me very well. So we can see that and other on the margin buyers of gold have had a pretty big positive impact on the price. There's been this huge Bollinger Band squeeze breakout. So what's a squeeze breakout? Direct your attention to this top chart here. You can see this is a measure of Bollinger Band width, or basically the distance between the top and bottom band. When that gets constrained, that is a squeeze. That is a period where there is low price volatility, where there is a small range of price. Often is the case when you have a Bollinger Band squeeze, it leads to some kind of breakout. If you think about it, if you take a spring and you kind of squish it together as much as you can for as long as you can, eventually you're going to run out of energy to keep that spring squished. And it's going to bounce back and it's going to go back in the opposite amount of energy as it was squeezed, right? So it's kind of similar to this. You've got that period of that spring coiling up in that red box here. and then we broke out. Now, traditional thinking about Bollinger Bands is all backwards. A lot of folks say, oh, we're hitting the top band, it's time to sell or it's time to short. This line of thinking actually says the opposite. When you squeeze and then you break out, you can see we're breaking out above the top of the band, and we've not even revisited the 50-week moving average since. This tells you there's a continuation of volatility-driven momentum. And indeed, from that squeeze, you can see that that has built and built and built, and gold has continued to make new record highs. So while I'm a little concerned about the amount of gold speculation in China, I will say that when we zoom in on the price chart, it still looks pretty constructive. Now, why do I say that? I've been trading gold since about 2006, and the one big observation that I can take away is there's two types of ways that gold tends to trade when people get excited about it. The one type is this. It's this sort of steady stair-stepping higher. You make a gain, you consolidate. You make a gain, you consolidate. And you can see that here. Gain, consolidate, gain, consolidate, gain, consolidate, gain, consolidate, right? That's healthy. That's the type of gold bull market you want to see if you're bullish of gold. The other type is where it just goes straight parabolic and then crashes. And just about every parabolic move in any asset class doesn't end well, but especially in precious metals. I can't tell you that I've seen a single time where there's been a parabolic move with a happy ending for longs. So this type of price action in gold, it remains constructive, and it has me thinking that over time, there's more upside to come. My target remains $3,000 an ounce gold for the first half of 2025. So could we correct or consolidate from here? Sure, we could. But I'm still bullish on gold because you have this inordinate amount of central bank cutting and liquidity provision coming into the markets, and that tends to be pretty constructive for the shiny stuff. Now, looking at silver, I'm a little bit less optimistic, but I'm still constructive here. I need to see industrial demand follow on. This is the same with palladium, platinum, copper. The industrial demand needs to improve. But if silver can break above 32.43, I think it does have additional room. It certainly broke out of its downtrend, and it's looking more like a long-term consolidation here, looking more like a spring that's coiling up to really decide its next move. Bitcoin, which some call digital gold, is not really performing like gold. In fact, it's been the opposite of a safe haven when regional tensions escalated in Israel versus Iran. This conflict that's been going on kind of episodically month after month, Bitcoin sold off pretty ferociously, and there's been continuation to the downside here below that point of control. So it tells us sellers have an advantage here near term. We've had this market of lower highs and lower lows in Bitcoin, and it seems that's set to continue. So I'm pretty cautious of Bitcoin versus its precious metal competition, shall we say, particularly gold. Now, the US dollar is looking really interesting to me because there's been so much bearishness about it lately that we've actually seen something rather extraordinary play out. And I shared a chart in the Forex room saying, boy, the positioning in the Japanese yen is about as long as it can possibly be. And that's a dramatic departure from where we were before, where that positioning was completely wiped out to the short side. What does that tell me? Well, I like to look at positioning and momentum and trends and then overlay the big picture. And what I'm seeing here is the market's getting a little bit too bullish on the yen, and as a result, too bearish on the dollar. And I'm thinking if the dollar can hold above this 100.60 level on the monthly, that we're destined to go higher, probably as high as 106.72 or 106.73 before we encounter too much resistance. So that has me thinking one of the best ways to express that trade is long USD JPY. Right? Because we're getting on the other side of that boat where everyone's on the same side of the boat. They're all long. So imagine everyone kind of sitting on the right side of a boat and the boat's starting to tip over a little bit under the weight of everyone kind of out of balance. That's what I feel like we're at with the yen right now. When everyone's on the same side of the boat, it tends to get a little tipsy. So I'm thinking the dollar can have some room higher here. I would be looking to rates to see if rates can push a bit higher. We're seeing a little bit on the long end recently after that fear-driven buying. And that tells me the dollar could also move higher. Shifting gears into AI, I'm a little concerned about how far this rally has run because for the same reasons we discussed earlier, we're getting into earnings season and we're likely to hear a little bit more about whether all that CapEx is actually producing a durable ROI, that we're actually seeing new lines of business that can make money over time emerging here. If we're not, well, then a lot of this could be given back. So for now, we are seeing folks express concern. An economist out of MIT sounding the alarm on AI hype, saying a lot of money is going to get wasted, going on to say in his interview that AI is only suitable for about 5% of the jobs that it is being advertised as being capable of doing. So that brings us to a chart of NVIDIA, which has been struggling below this descending trend line, with a head fake look above that was met with some selling down to the 20-day, and now another peak above that is being sold down, at least as of the making of this chart. What does that tell me? It tells me that, we're really not seeing the strength come back. Even with Jensen Huang coming on TV and saying the demand for Blackwell is insane and we're on track for production, doesn't seem to be giving the market the same kind of juice that it would have, say, back over summer, where that probably would have given us a 10% up day. Instead, it's maybe giving us, 2% today? That's something to be a little bit concerned about, that muted reaction, which to something that ostensibly should be very good news. Maybe the market's growing a little bit more skeptical about those demand trends. And that brings me to the NASDAQ, because the NVIDIA's rally, the story of AI, that's been one of the biggest drivers of upside in the NASDAQ. And yet here we are struggling below a key amount of resistance overhead. So if we're not able to get above 484.56 on a weekly closing basis, that's where I get a little bit more concerned about these tech stocks, particularly as we get into earnings season and a more precarious period of seasonality around the election. On the other side, excess liquidity, like this global rate cutting cycle, tends to be supportive for oil and things like gold. So if we look at XLE, we can see it's put in an inverse head and shoulders bottom, and it could have some room to run from here. Obviously, what happens to oil from here? There are a lot of different variables involved, but the low positioning, the potential for disruption, the potential for this port strike to go on and create more demand for energy has me looking at some of the better quality energy names with some degree of intrigue, thinking there could be some follow-on. So that's everything I've got for you all. If you have any questions, let me know. But I wanted to share this because I think it's a good overview of what all is going on in these markets.